Okay, welcome everybody. What is this? Our third general meeting? I lost count, but I'm happy to see everybody here. We'll go ahead and get started. We have a lot on our agenda. So, general meeting agenda. I'll say my quote here of the week. We'll start with the market outlook right away. And then at the end, you will want to stick around because we're going to be voting on t-shirt designs. We're finally going to have more than just our polos. We're going to get some nice comfy t-shirts that you can rep during class, at the gym, anywhere you go. Just promote the investment society more. What is that? Okay. So our weekly quote today for the investment society is take the risk, you'll thank yourself later. A little quick motivational thing here for taking that risk. So if you were thinking about, I don't know, joining a certain team or applying to an X position, definitely take the risk. You make it or not, you will thank yourself in the future. And I like the little graphs I put there. Look at this guy. He's getting to a great end goal. Now for everyone's favorite part, outperforming moments. Can I get 3 outperforming moments for their week? Yes. Nice, congratulations. Great job. Round of applause. Another outperforming moment. Impressive, congrats. All right, outperforming moment for the week. Anyone? Yes, Waylon. I think I saw Waylon. Nice. Good luck with that. Nice. Good job. All right. Now let's keep it moving with our market outlook by Juan Carlos Gallegos. Round of applause.
Hey, what's up, everyone? Let's get started. So today we're going to talk about market recap. Then what are the analysts thinking about the market currently? Then we'll go over an IPO performance this year, China, Apple, and a chart to end the day. So first off, this is a chart of the biggest or the most popular indexes from Monday and the past 5 trading days. Obviously, everything was down a lot. The S&P was down almost 5%, the Dow 4.44%, the Russell 8%. And for those who don't know, the Russell 2000 is an index that tracks 2,000 of the smallest companies in the Russell 3000. So first, last Wednesday, Fed Chair Jerome Powell forecasted the unemployment rate to hit 4.4% next year from 3.7% right now. Why is this important? Because this means that 1.2 million people are going to be out of employment. Then the Bank of England announced a debt finance tax cut, borrowing more money in foreign markets, adding to inflation, which is obviously something we don't want, inflation. And the Bank of England was a big thing because that basically was what placed equities 5% down for the week, which is something we didn't want. And that meant that all major indexes were down more than 20%, which meant all of them were in a bear market. The last one was the Dow Jones, which is the last one to go into 20% down year to date. And the S&P 500 hit its lowest level this year, dropping to 3644. Now, this is a chart of the whole stock market of some of the most popular companies per sector. The Amazon was down 8% in the last 5 trading days, Tesla 10%, Exxon was down 8%, Chevron down 7.4%. Everything was down, United Health, even the banks were hit really hard by the Bank of England. The announced by the Bank of England, JP Morgan down 7%, Bank of America 7%. Now, Susan Collins, president of the Federal Reserve, said, we're committed to bringing down inflation, even if that means slowing down the economy. Everything analysts say, and even presidents at the Federal Reserve, are things that hit the markets really hard. Now we have Paul Donovan, chief economist at UBS Global Wealth, said, my worry is that there's a sense that the Fed's going to raise rates until it breaks the economy or something breaks. Then we have Brando Reina, portfolio manager at Novair Capital. He said the market is finally coming back to reconciling the steps the Fed is indeed going to take. So this is something we talked about last week with a columnist at the Wall Street Journal, that the markets weren't taking into consideration the effects raising rates was going to have in the entire stock market. And lastly, Jeremy Schwartz, Global Chief Investment Officer at Wisdom Tree Asset Management, said, We are worried the Fed's current trajectory is more aggressive than necessary. Now let's talk about IPOs. An IPO is when a private company offers shares to private markets to public markets for the first time. And they can do that afterwards a bunch of times, but it's whenever they do it for the first time. This allows companies to raise equity capital from investors and then expand quickly. In 2012, Meta went public and raised 16 billion, breaking the record for most money raised by a tech IPO, which was 16 billion. And sadly, for the next year, Facebook went down 40%. And that's the story with a lot of the IPOs and even more on 2021 and 2022. So IPO's performance this year. 87% of companies who went public last year are trading below their IPO price. This is not a surprise, but what's worse is the next statistic. On average, those IPOs are down 49% this year, while the S&P 500 is down 23%. So in 2020, with low interest rates, a lot of people were putting money in IPOs because whenever interest rates are low, small cap companies tend to do really well. So this hasn't been the case, obviously, for the past year and a half. In 2021, 149 billion was raised through IPOs. So far in 2022, only 7.2 billion has been raised. And this also talks about the volume. Here we have a chart that more or less shows that in 2021, about 400 IPOs happened. And in 2022, we've had like 60. Now, why are IPOs not happening anymore? First of all, falling stock prices make everything look cheap. Companies want to IPO when everything is expensive. This way they can boost their valuations. So for example, Facebook was worth $300 a year ago, like 600 billion. Right now it's worth like 300 billion. So if a social media company wants to go public, they can't use Facebook's valuation of 2 years ago. They have to use the one right now. So that means their valuation isn't as big. Now let's talk about investment banking. The performance of investment banking in Q2 per bank. So JP Morgan Chase was down 36.8% year over year in Q2 for their investment banking revenues. Goldman Sachs was down 41%, and Morgan Stanley was down 54% year over year. Now let's talk about China. So the World Bank has forecasted China to grow 2.8% in 2022, down from 8.1% in 2021. On the other hand, Asia, excluding China, is expected to grow 5.3% in 2022, up from 2.6% in 2021. Rebounding domestic production and lenient COVID restrictions have allowed them to continue growth. Obviously, China has had really strict COVID lockdowns, which meant that not only did it affect China's growth, but also companies around the world, the supply chain issues were a big thing, and they're still happening. So this is Aditya Matu, the World Bank's chief economist for Asia and the East Pacific. She said, China, who was leading the recovery from the pandemic and largely shrugged off Delta difficulties, is now paying the economic costs of snap lockdowns and mass testing. Now, this is another important thing. Right now, China is going through a real estate collapse, and 29% of China's GDP is real estate. Now, for context, 16% of the US GDP is real estate, and only 6% of Mexico's GDP is real estate. So the fact that real estate prices have dropped 30% year over year in China is kind of a huge dent on their GDP growth. So last year, China enacted the 3 red lines policy to end speculation, over-leveraged developers, and potential bubble in real estate. Developers weren't meeting the policies which stated that developers had to have a liability to asset ratio of less than 70% and a debt to equity ratio of less than 100%. One of the biggest companies there was Evergrande, and Evergrande had a 177% debt to equity ratio. So one of the things they would do is that they would finance current projects like luxury buildings with money from people pre-ordering houses. So another thing in China is that people pre-order houses and they would make a down payment and they would pay a monthly mortgage for a house that hasn't even been built. The house is probably was going to be built in a year. And that basically got people really, really mad. So when money dried out during the pandemic, they began borrowing more money and a slippery slope began. So as obviously the pandemic came in, nobody was buying their buildings. So they began to get more money through borrowing. And then obviously China enacted the 3 lines policy. Developers couldn't borrow anymore and began defaulting on payments. And then people found out they stopped building their houses, so they stopped paying the mortgage on their pre-ordered houses. And they started protesting, and that's them outside of a bank. Now let's continuing with supply chain issues in China.
You need to move.
As companies face obviously supply chain issues in China, they're starting to change to other countries. Apple was talking about making the iPhone either in Vietnam or India. Now they're doing it in India, and a lot of other companies are starting to do some of their manufacturing in Vietnam and India too. Apple announced it would manufacture the iPhone in India to diversify its supply chain. And one interesting thing is that the company that manufactures iPhones in China is Foxconn, which is a Taiwanese company. And in order to keep the quality, they decided to bring Foxconn to India. So now Foxconn is still going to manufacture the iPhone, but now they're doing it from India instead of China. Now, this happened today. So today, obviously, the Bank of England was a really heavy, important thing that made equities go down. And today, equities rebounded after the Bank of England announced it will be buying as many long-dated government bonds to stabilize financial banks. Hopefully, the chief economist talks about this. It's a kind of complex issue for William if he wants to talk about it. But essentially, it stabilized financial markets, and it meant that things were going to be good. Now, this is a great chart. This chart is like the other one, but this is year to date. So here we can see which are the sectors that kind of performed better than others. We have Microsoft down 30%, Apple 16%. We have here Exxon up 40%, oil still doing good, even though obviously it was down 10% this week. Chevron 23% up. We have ConocoPhillips. Even also a lot of consumer staples, including the beverage industry, they've done relatively well. Coke is only down 1% and Pepsi is only down 3%. Well, obviously we have banks here down 30%, and the tech industry is also down heavily. And that's it. If you have any questions, feel free to ask me after the meeting.
All right, we got a lot of things to talk about. Economy was, pretty rough, this past week, 2 weeks. Got some good news, some bad news. Go over it. Mostly bad news, all right. There you go. All right, so first I'm going to talk about, what are leading indicators and what are lagging indicators. So leading indicators is data that's used to predict future events. It helps predict trends, right? So, I have an example there is housing starts. If housing starts increases, that means there's more people going to buy homes, more people are going to take out mortgages. There's people going to, in the future, going to buy furniture, appliances, which all helps the economy, right? So that's a leading indicator that helps predict future economic activity. There's lagging indicators, which is indicators that record past data, right? So it helps confirm trends. So CPI is an example. You see CPI go down and down and down. That means inflation is coming down, 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 right? So it helps predict, it helps confirm these trends. So the reason I'm saying that is because last week we had this week, they had the LEI come out, which is the Conference Board's leading economic index. So there's 10 things that are incorporated in the LEI, right? So that average weekly hours worked by manufacturing workers. That's a reason because that means the companies are paying their employees, right? They're finding labor. Also, the employees are making money and income, which they then spend in the economy, right? And there's average number of initial applications for unemployment insurance. So this tracks see if unemployment is rising or decreasing. That also affects income. If unemployment insurance applications rise, that means there's less people making money. So you have volume of manufacturers' new orders for consumer goods, durable goods orders, which is similar to the consumer goods, but this is the kind of the appliances, bicycles, furniture that people are buying. Volume of new orders for capital goods. So I put used by businesses. So this is tracked for what businesses are buying, right? So if businesses are buying a printer for their office or something like that, or construction companies buying materials and equipment for whatever they're building, right? So number of new building permits, same thing. If building permits goes up, this means that the builders are going to start building, and they're going to have to get all the materials and all the labor, which all costs money. The laborers make money, they spend it, right? So S&P 500 is also a leading indicator as well. We're now, showing, the economy, or stock market's in a bear market, so it's showing that, we're not in a good place in the economy right now. Inflation adjusted monetary supply. So it shows, the amount of money that's circulating in the market. So there's, a lot of money in the market, which there is right now. The Fed is decreasing by selling their bonds. So that shows that's also a leading indicator. We also have the yield curve, which is used, basically by investors to gauge future economic activity, right? So, the yield curve right now is inverted. So that helps tell investors that there's probably a recession nearby. And also consumer confidence, consumer confidence is the main thing. If consumers are confident about the future, they're going to spend more money. Consumers are not confident, they're going to be, I'm going to save money, I'm not going to invest, I'm not going to spend. So those are some important things. So this week we had, the leading economic index come out. It's negative 3%. That was the actual. Previous was negative 0.5%. This is actually the 6th month in a row that it's come out negative. So it's giving an indicator that a recession is likely, recession is nearby. We also have durable good orders that came out at negative 0.2%. So I think this is the 2nd month in a row it's negative. So it's just showing that consumers are buying less bicycles and appliances and things like that, right? We also had consumer confidence index, which is just quite odd, right? Came in higher than previous. So consumers are becoming more confident about the economy. This is mainly to do with gas prices coming down, right? Gas prices are coming down. They're like, okay, now we have a little bit more money to spend on different things, right? Now they can go out more and spend on, beer or alcohol, right? Buy clothes that they couldn't have otherwise bought because of gas prices being high. All right, so now let's get into the international economy, right? We had Europe, some big news. Anyone hear about that? Bank of England, yeah, not pretty bad. So in Europe right now, it's energy crisis, right? Utility bills are surging, cost of living is rising. Still having those troubles from the Ukraine and Russia war. Russia has stopped sending them gas and oil. So I think right now their biggest supplier is Norway. So they're struggling with that. Also, consumer confidence. UK has the largest decline in consumer confidence because of their inflation rate reached 10.1%. I think now it's at 9.9, if I'm not mistaken, somewhere around there. It did come down a bit. We also had the euro and pound are near parity with the US dollar, right? Well, actually, I think the euro is actually below parity now. The pound is near. So yeah, one pound is $108 and €1 is $97, right? So this is important, right? Because investors or hedge funds or these big investment management firms, right, or pension funds as well, they invest in other government bonds, right? So if the government bonds are going down, that means our pension funds and investors are losing money, right? If the price is going down, the yields are skyrocketing. So what Bank of England did, well, I saw it happen, right? So because of the Bank of England or the governments, the UK governments cut tax rates. So they did this as trickle down economics, that's what it's called. They cut taxes for the top percentage of income holders. They do that as to that they'll spend more money, they'll invest more money, and it'll all trickle down back to the economy, right? So they did that, and investors, didn't really like that, and they were kind of confused about it, right? So the yields went up. Now they were selling out of their bonds. Yields skyrocketed. Then Bank of England came in, and they're like, you know what? Like we're gonna settle everything, all the nervousness in the market right now, and so they started buying. So the Bank of England is raising interest rates, but also buying long-term securities at the same time. Sorry, China real estate market, as Juan Carlos said, is pretty bad right now. Evergrande defaulted on their debt, and that was mainly a part because of the practices they were doing. So they would, as Juan Carlos said, I'm gonna explain it again. So So they would get they would start building, they'll get permits, start building a tower, a multifamily tower, right? And they would start getting pre-leases, right? So people would pre-lease the apartments that are not even built yet. And they would use that pre-lease money to get leverage on another construction property. And they'll start there and they'll pre-lease that and then start getting another leverage to get another construction property. And so they just got so much in debt. And one that three strike, the red, what was it called? What called this? Three red line policy ended, right? They went into debt, right? And then right now, Country Garden is another big developer. So they're expecting in their earnings 70% decline in sales from last year, right? Pretty big. You know, also those mortgage strikes that are going on right now. So they also have a supply chain crisis, right? They're pretty heavy on COVID lockdowns right now. I think the 8 major mega cities are under lockdown, right? They also have a heat wave right now. So, you know, some of the businesses aren't up and running. Some of the manufacturers aren't up and running. So that's causing a little bit of a supply chain crisis. And they're saying there might be an earnings recession. So an earnings recession happens when earnings start to decrease, quarter over quarter. And so they're predicting that 53% of Chinese companies are going to post declines or posted declines in their net profit for the first half of 2022, right? So if they come in negative again or declines again, that's what they call it, an earnings recession. All right, so we got U.S. market outlook, right? So we got real estate. This is interesting. Look, just read this. 30-year fixed rate mortgage on a $600,000 home at 2.6% in 2021 has the same monthly mortgage payment as a $392,000 home at 6.2%. Think about it like that. Now, prices have risen and interest rates have risen dramatically. The demand is drying up now, right? People are running out of money. Interest rates are high, and people don't want to buy. Supply is also limited, which is interesting. Suppliers are reluctant to put their homes on the market right now. There's not a lot of supply. There's not too much supply coming out in the market, right? Pending home sales have dropped for the 3rd straight month in a row as well. All right, so stock market. We saw that stock market's been down. Today was a good day. Not for the market watch competition. All our bears, we all got wrecked. Andrew. So it wasn't a good day. It was a good day for the stock market, but the Dow entered bear market territory. S&P, I think, still in bear market territory, as well as the Nasdaq. So Goldman Sachs cut their target for the S&P 500 to 3,600. I think right now it's at 37, around 37. So they cut their target, and this is their 6th cut for the year, right? So they started at 4,600, so now they're at 3,600. And they're citing the reason is they're citing interest rates increases. That's why the stock market's going to go down. So now all eyes are on Q3, right? So we want to see if earnings are going to drop, or if they're going to stay steady, or if they're rising. If they're rising, that's a good thing. Or maybe not so much, but it's companies. If earnings starts to come down, that demand is waning, right? Demand is coming down. So we have the bond market. Deutsche Bank said, this is bonds are in the first bear market in 76 years, right? This chart here is from the Bank of America. They're calling this the 3rd great bond bear market. In 2020, so they dropped 20% from the peak. Right? So the prices have come down. So it's a big one. Investors not sure what to do. All right, this is it.
A couple $1,000s to even 5 figures. And think about that. It required no money, just time.
Hello, everyone. Hope you all are having a good week. Passing tests. I know this is test week. So let's go ahead and get started with mergers and acquisitions. Maybe? Are we clicking? Okay, we're clicking today. Adobe acquired Figma on September 15th for $20 billion. So let's talk about the history of Adobe real quick. In 1982, John Warnock and Charles, I'm not going to try, two computer scientists at Xerox created a new computer language called PostScripts. The language specialized in digital page images for printing. So vectors, it's complicated. We don't really need to understand exactly how it works, but it changed the way printers were able to print. And then after Xerox leadership rejected the idea, the pair quit and created Adobe Systems out of John's garage in Palo Alto, California, naming the company after the Adobe Creek behind John's house. So there was the original logo. And so there is, I believe, Charles on the right, and in the middle is John. And can anyone say who's on the left? Okay, Steve Jobs, yes. So in less than a year after forming the company, Steve Jobs offered to buy Adobe outright for $5 million. John and Charles instead talked Steve into a 19% investment of the company and a 5x at a 5x multiple to give, and also to give Adobe a 5-year contract to use PostScripts paid in advance. And then in 1987, PostScripts became the industry standard for printers. And then about 400 software programs and 19 printer companies were using PostScripts. So then they came out in 1989, launched their flagship product, Photoshop. This is what it looked like in 1989. And so let's talk about Adobe now in 2022. Adobe is now it's a massive multimedia company. I'm sure most of you guys are familiar with it. It has the creative software and a portfolio of products, a very sticky business model. So here's all their products and the new logo. So you can see you have Photoshop in there. There's quite a bit of different products. And then they're at a $133 billion market cap as of yesterday, and trading at a PE ratio of $28.06. So figured you'd also like to know that Adobe is actually free to UTSA students. So if you want Adobe's Creative Cloud tools, you can go ahead and get it as a student. I went too far. There we go. Figma is a browser-based UX design tool that was launched in 2016. Since that time, it has become the leading tool in the industry. So a company went ahead and did a survey on with 3,000 design professionals, asking them about what softwares they use. And so for UI design, Figma, #1 by a large margin. You can see in 2017, they were about 10%. And at 2021, at the end of the year, they are sitting at about 76% or so. And so they're also #1 in UI prototyping. Very similar chart, as you can see. And then, so they're not #1 in whiteboarding, but that's actually kind of wrong because they own FigJam and Figma, which is #2 and #3, which would make them #1. They're also #1 in developer handoff. And they're #1 in managing design systems. I haven't been mentioning it, but Adobe is #3 on most of these with their Adobe XD. And then they're also #1 on versioning and file management. And then they asked, what are you most excited to try to all the developers? And Figma ran away with the #1 spot, just destroying everybody. So you can see Figma is a very loved tool in the design community. And they have gone and deranked everyone else. And so what are some reasons Figma became so dominant? It's a browser-based real-time collaboration tool. And so it's a lot like Excel versus like Google Sheets. If you have a team working on the same sheet, you can do that versus with Excel, only one person can work on it at a time. Very intuitive user interface. Both design professionals and other stakeholders who don't know as much about these tools can use it. And then it also includes prototyping. A lot of the other tools did not have prototyping in it. And then the company is very customer focused and developed a strong community where you can post about what you've made on Figma and talk about different things, much like Tableau does. And then it's free to individuals and companies with UX teams that are less than 3 people. That's a look at what the prototyping looks like. You can see there's MJ, they're very dominant. Back to the actual deal. On September 15th, Adobe acquired Figma for $20 billion. The deal was about 50% in cash and 50% in stocks. Figma is projected to have an ARR of $400 million, which puts the acquisition about a 50x AAR, which is pretty expensive. So what AAR is annual recurring revenue. And then they're a SaaS company, so it's software as a service. Much like Adobe, you buy their product and it just recurs every year. And so that 400 million of annual recurring revenue is just you understand. The $20 billion deal does not include the additional 2.3 billion 4-year retention package as well. About $1 billion of that going to the CEO, Dylan Fields. You can see him there in his golden handcuffs. He's looked at as a potential next successor for CEO of Adobe. So what are the top 3 reasons for the acquisition? To take a fast-growing competitor out of the marketplace and rebuilding its economic moat, to use Figma's web-based expertise to help accelerate Adobe into getting its products to be web-based, and then increasing the offerings to both customer bases. You can take some things that Adobe has and put it on Figma, and then it can add Figma to its creative cloud studio. And so how did the market respond when the deal was announced? Anyone want to guess good or bad? Did the market think the deal was very good or very bad? It's 50-50 shot. It was very bad. So the Adobe shares plunge after acquiring Figma. Adobe on Thursday, as you can see the key points. The company also reported some earnings that day, and the earnings were on par, but the outlook was kind of shaky. So that also hurt the stock that day. Adobe had its worst stock day since 2010. It was down about 17% or $29 billion in market cap, so more than Figma. So here's Adobe throughout the whole year. As you can see, year to date, they're down about 50% as of yesterday. So why did the market hate the acquisition? The first was just the price. They paid a large amount for Figma. They're basically paying like 2021 valuations in 2022 after the Fed has unplugged the money printer, beat it with a sledgehammer, and started beating consumers with a sledgehammer as well. And so it's also seen as a defensive move. So the company should be on the offense. It should not have lost this economic moat to this brand new company by a 20-something CEO who started in 2016. So the fact that they had to go ahead and buy the company to get back that economic moat is shown as like its weakness, and there could be a new company that comes and gets a different part of their company. And so it's kind of seen as like, maybe this company isn't as strong as it used to be. And then just less confidence in the leadership after having to buy the company for the high multiple. So that was my M&A presentation. I also have on Thursdays at 1 p.m. The semiconductor sector with Brian. We're co-leading it. 4 p.m. 4 p.m. Anyway, don't pay attention to that part. But semiconductors, it's going to be great. We're going to win the sector wars. Calling it now. I would bet my money on it, but I've lost it all in crypto. And then on Tuesdays at 1 p.m., I teach the Tableau class. So with Tableau, you're going to be able to get a tool on your resume that is on quite a bit of job postings. Actually, people come up to me all the time saying, hey, I really should learn Tableau because I keep seeing it on all these job postings. It's actually pretty easy to learn. After the semester, you go to my class for 45 minutes a week. At the end, you're going to have it's going to be a project, and you're going to be able to link it on your resume next to where you say you know how to use Tableau. So they can actually go ahead and look and see that you actually know how to use Tableau, which is good instead of just saying, hey, know how to use Tableau. All right. So that was my presentation. Go ahead and sign in. Where's Anna?
All right, everybody sign in the QR code. I think everybody knows the drill here. Our treasurer, Jason, will keep track. Is everybody good? Give me a thumbs up once you're once you signed in. Okay, everybody. I think everybody's good here. Oh, I see a phone up. Okay. Perfect. All right, now we'll continue with our agenda here. We have the sweet spot where Professor Sweet will cover some items here. Round of applause.
Let's do growth. All right, how y'all doing? I do have a outperforming. So today was my 2,750th day in a row on a bike. So that counts for something. Y'all need to, I'm a big believer in the streak. I've gotten so many people hooked on streaks. You get a streak like 20, 30 days in a row and you'll become obsessed. It needs to be a good streak. Don't like how many days in a row you smoke a cigarette or something like that. But how many times you exercise, you're in your 20s. That's when, you know, health issues, you're working long hours. So start finding a way to put a streak together and then do whatever it takes to keep the streak going. Boy, it really keeps you in shape. All right, so I had this curiosity. We've been talking a lot about tech stocks and growth stocks have really dominated the market the last few years, and then they pulled off this year. So did you miss your chance to switch the value? Is it too late? Are growth stocks cheap now? And so I went back and I pulled the Russell 1000, the Russell 2000, Russell 3000. So the 1000 are the big companies. The 2000, as Juan Carlos talked about, those are the small companies. And then the 3000s, everybody. I pulled their PE and their price to book. Price to book is the traditional way to distinguish between these. So a growth stock is a great company. It's growing fast. It's profitable. It's got a lot of good news going for it, but it's also expensive, and it makes sense it's expensive because it's a great company. And value company is struggling. They've had some problems. Their earnings are down. Their revenues are down. And because of that, they're cheap. And as I tell my investment class, don't confuse value with quality. What's higher quality, a growth company or a value company? Growth or higher quality. Some people hear value and think, oh, that's high quality. No, value or low quality, and they're cheap. You can hear in the title, value, it makes it sound like they're cheap. They may not be cheap. They may just be horrible companies. So as, forget his name. I always forget his name. Howard Marks, as he always says, there's no bad assets, just bad prices. So, are they too expensive or too cheap? So what I was curious is how have growth stocks done? So if you look long-term, what you do is you can take growth stocks divided by value stocks, and it should always be above 100%. Growth stocks should always be more expensive. I'll talk about the one exception in 2008. But what is this right here? That's the .com. That's when growth stocks just got ridiculous. And I remember back then, people were saying, don't worry about it. It's different this time. They really deserve to be that much more expensive. And those people, I had people in my church saying, I remember this one sweet little lady came up to me, Ron, I can't get my broker to sell all my stocks and put it all in tech stocks. And I said, tech stocks are like ridiculously expensive. And she thought I was an idiot. She walked off and like pat me on the head. I thought you were a finance guy. You obviously don't know what you're talking about. I hope she didn't go do it because she would have lost a lot of money. And then, but you look at that, that's the cross line at 1.5. So growth stocks are generally about 50% more expensive than value. What does that mean? If a value stock has a PE ratio of 20, a growth stock's will have a PE ratio of 30. About 50% more expensive. And it makes sense that they should be. All right. Now, I think what happened in 2008, I had to go check. I think what happened in 2008 wasn't that growth stocks got really cheap, but it was that value stocks earnings dropped so much that their valuations just looked exaggerated. So I think that's what happened, but I can't guarantee that. I can go check it. This is somewhat distorted. So you see here, here's the big rise that we've seen here in the last few years. But it's distorted because of .com. So let's take the .com out. So right now, growth stocks, they've come down. You can see it. Y'all see that massive drawdown? Doesn't look all that massive. That's a pretty massive drawdown. There's a pretty massive drawdown. So it's pretty volatile. They never got cheap though. So they got real expensive here. Now there's a few things with growth stocks. See if anyone in my investment class remembers. Do growth stocks like interest rates rising or interest rates falling? Falling. Why is that? Because so much of their valuation is way out in the future because they're growing fast. So they like lower rates. What have interest rates done this year? They've risen. So that's bad for growth stocks. Do growth stocks do better in recessions or in strong economies? And don't answer that too fast. Remember, they're high quality companies. What do you want in a recession? High quality or low quality? High quality growth tend to do better in recessions. Value tends to do better in strong economies. So we got this strange problem. I've been doing value stocks this year. We got this strange thing. Interest rates are rising. That's bad for growth stocks. But we might have a recession. That's bad for value stocks. So what do? The answer is probably just get out of everything. But I don't think you can say growth stocks have sold off now get back into them. They're trading right now at an 89% premium, and normally that are like 1.4, 1.41. And even if you take the .com out, the normal, I said 50%, but it's really 39%. The normal premium, if you take .com out, is 39%. Right now, they're trading at 89%. So they're still expensive. So there's still an opportunity, but right now it's really tough. You got to figure out if we go into recession, value stocks they're not going to do well. Interest rates keep rising, growth stocks aren't going to do. So there's almost nothing to do. So you have to pick your economic equation. So Jeremy Powell puts us into a hard recession. You don't want stocks at all. So put all your money in 30-year treasuries at the right point before the rates rise. Before they hit their top, get right there at the very, very end if you're smart. Juan Carlos Sotos, exactly when that is. But you still have the opportunity to get in the value stocks. I think, how good are value stocks when they outperform? I mean, you get some periods where they really can do quite well. That was a period of time, where if you were in value stocks, you didn't even notice the 2000s stock sell-off. Value stocks did perfectly fine. You had this huge stock sell-off and value stocks did fine. That's how dramatic it was back then. But the nice thing to know is people have been talking about growth stocks doing so great, but they've been a lot more expensive than today's. So it's not the end of the world. All right, how am I doing on time? Do I need like 2 more minutes? Okay. Yeah, I've been riding a bike for 2,000 days. Give me. All right, I don't know where that one is. Where did it go? Is it? Oh, here it is. Okay. One last thing, I talked to my security analysis class and my, I think another class yesterday, but I had a student in my graduate class. She wanted to do a company. I said, oh, that's fine. That'll work. And then I looked it up. Had negative net worth. Its liabilities are greater than its assets. I said, oh, I can't do that one. So she sent me another company. I said, that one will work. And I go look it up. Its net worth was negative. I go try another one. I say, what about Starbucks? Oh, Starbucks will work. No problem. Go look it up. Negative net worth. So we went through 5 companies. She started with Chick-fil-A. I said, that won't work. That's not public. But look at this. Have y'all heard of any of these companies? Home Depot, anyone ever heard of Home Depot? Their net worth is negative $1.7 billion. Does that sound good? Liabilities are greater than assets. Any of y'all bragging about that? Doesn't sound good. McDonald's, anyone ever heard of McDonald's? Negative net worth. Oracle, Philip Morris, Lowe's, Starbucks, Boeing, O'Reilly, AutoZone. You notice there's a lot in certain industries. Now you might say, well, that's bad. They must have lost a lot of money, but why are their equities negative? They did it to themselves. They bought so much stock back. This is strange. I've never seen this in my career. This all started happening about 5-6 years ago. Why are these companies buying so much of their own stock back that they're causing their net worth to go negative? It's really irritating because it makes it really hard to analyze them. I don't know, where's William? I don't know, William, this is a problem for bond investors. Are y'all noticing? But you must say, well, if they're insolvent, they must be junk bonds, but Home Depot is a single A rated company. You see triple B rated companies, their ratings aren't horrible. They're investment grade. Now at the very bottom of the list, yeah, you got some pretty bad, there's a bad company. But I don't know the answer to this other than people say interest rates are low or they were low and people are borrowing money and buying their stock back, but that's really bad finance if they're doing that. If you did Miller Modigliani, that doesn't make much sense. I don't have the answer to it. I don't know if any of y'all have why firms suddenly are buying so much stock back. I understand if they have a lot of extra free cash flow and they're just really profitable and they buy their stock back, but why they would take it to the point where they actually take their net worth negative, it's just bizarre to me. So if y'all have an answer, email me, let me know, because I haven't seen this before. All right, I'll stop there so you can do your vote. Gracias.
Awesome. Thank you, Professor Sweet. I'm actually going to have Juan come up here and announce some exciting news for all of y'all. What we got upcoming for the next 2 weeks. Juan, round of applause.
Thank you. Thank you. Can I get a drum roll, please? Bam. Tailgate, guys, October 8th. I hope you all show up to the game. We're going to hold the tailgate around 1:30 p.m. We might cook burgers, hot dogs. For sure, we'll have snacks, sodas. You know, you might have to buy them, but it's all right. And how many of y'all like to drink alcohol? You know, that's pretty popular. I will have Drew please come up and talk about that. I can't talk about it because I'm a minor. I'm under 21, so I wouldn't, you know.
It's all right. 21st coming soon. So I'm the designated disciplinarian. I don't know if that's true or not. But anyway, real talk. We need to minimize risk, right, at this tailgate. So I'm dead serious when I say that if you are not 21, you will not have alcohol at the event, right? To drink at the event, you need a wristband, right, that I will be administering, right, given to us by the, the organizational committee, something like that. So yeah, and I will check your ID personally. I will be the person to do that. It's going to be a BYOB if you're 21, right? If we see you drinking without a wristband, I'm going to ask you to leave. It's that simple. Understood? Questions? Awesome. Thank you guys. Back to Juan.
All right, and another future social, we will have a board game night with OSA, and Jordan is actually here, president of OSA. Please, round of applause. And for this game night, I'll put in the Discord. You know, like feel free to bring your own games. I put STEM versus business. We're not really against them. You know, just socializing. But you know, I'll update that information later. But for sure, you know, be excited, especially for that tailgate. I've personally never been to a UTSA football game, which is bad, but you know, this will be my first time. All right, thank you.
Awesome. A lot to look forward to. It's actually going to be my first tailgating too, I think. I don't know. I don't recall. Updates on the Market Watch competition. Everybody's, has high competition there. Congrats for being first for now. I'm like 19th right now, but yeah. Oh, so we announced, we finalized the gift cards we're going to be giving out. First place will receive a $100 gift card. Second place, $80. Third place will get $60. So fight hard to be up there. I know the market's tough, but I mean, some people are making returns there. All right. And now for the t-shirt design competition. Thank you all so much for those who actually submitted designs to our email address. We're going to get to vote now. We had a total of 7 submissions. Get your phones out. There's going to be a QR code at the end that's going to let you choose the number that corresponds to the design that you highly prefer and would want a t-shirt of. So these are the first 3 options out of 7. I'm sure we can make a few minor adjustments, but the overall design, this is what we got going on. Have a look, examine, any comments on that. I think number 3 is pretty nice looking there. Our logo, of course, zoomed up on number 2. That's pretty dope. And then number 1, the Investment Society. All right. We will come back to these. These are the other 3 designs we got going on. A little similar, some different. Number 6 is pretty unique there, a little different. We're gonna look into having that like code thing actually like scannable on your phone to see if that's a thing. I'm not sure though, so we'll look into that. Number 5 there and 4. All right. And then the final design is number 7 right there. And then I have on the right side a little recap of all the other designs we showed. So whichever is your favorite, the preference, they're all black t-shirts, but I think we could change the color. I don't know. I like the color black. I like that one. I think it's part of the Investment Society, so it's pretty nice. Now let's get to voting. That's the QR code. Hope everybody decided on their favorite. And we'll be seeing those responses here soon, and I'll probably announce that maybe by later today. Thumbs up when y'all vote. I hope my favorite one wins. I can't say because I'm like bias or something, but yeah. Number 6? Yeah, number 6 is the front of it. Number 3 is in front. All of these are in the front except I think number 4 and 2. Yeah, we can make adjustments. Oh, wow. All right, everybody good? Thumbs up. Hopefully I'll look at that recap later and show y'all the news in Discord and Telegram on the winning design by tonight. Thank y'all for voting. And now, of course, we're going to be selling our polos at the end of the meeting when I mean, we're about to wrap up here in a bit. $20 for members. Our treasurer, of course, keeps track of who's paid their dues and whatnot. And dues are due on October 5th. That's the final deadline there that we've set. If you have any like issues on that, feel free to like reach out to any MDs. Maybe we can work something out. I know rents due like soon. So yeah. And thank y'all for the exciting part, gift cards. You ready, Jason? No.
All right, for everybody's favorite part, we have 2 winners. I'm marking out on the names. So can I get a drum roll, please? Victor Rodriguez, come on down. Oh, right there. Oh, already down. All right, man. You want to get his information? Another drum roll, please. Last winner goes to Leonardo Martinez. Oh. And winner number 3, just kidding.
All right, thank y'all for joining again. Once again, our link tree's up there. Scan that. Join the Market Watch if you haven't already. It's not too late. You've already seen how some people are performing. I'm in the negative, so I mean, it's changing. But thank y'all for coming out. See y'all next meeting. Bring some next meeting next week's. Bring some friends, and hope y'all enjoy the rest of your night. Thank you, everybody.